See you back next week again. Thank you. Jitendra Gohil is Head of India Equity Research at Credit Suisse Wealth Management, and he's now joining us to take some questions and analyze markets with us. Jitendra, good to have you with us here. What are broadly the implications of this pause by the RBI, and is it going to be long-lasting in terms of giving a push to markets from here? Because from the lows in just 5 sessions, the Nifty's already done about 600 points or so. Does it add more, in a way, fuel to the fire? The good fire.
Hi, Prashant. Hi, good afternoon. Yes, we have been expecting RBI to pause. It was a little, probably a contra call, but our expectation is that 6% of inflation in India is actually desirable. And we have seen that rural slowdown is happening. We have seen that the lower end of the consumption is struggling, whether it's lower cost housing companies or lower cost housing market. So we think that it's a prudent move. Market was expecting 25 bips rate hike. So we think that there could be some positive sentiment to this. But on the other hand, Indian economy is also doing pretty good. Look at last 2 years, we have revised our GDP projection numbers upwards, and on that higher base, India is going to grow at 7%. So inflation is under control, and the growth is not that bad. So I feel that yes, market will take it very positively this move.
All right, hi Jitendra, Nigel on this side. Good to speak to you, Jitendra. You're saying that at around 17.5 times, the Nifty is trading more or less in line with what the averages are, but you're not ruling out further corrections from here on. And then you're factoring in a good recovery in the second half of the year. So two-part question. One is, what do you think in terms of a downside? How deep can we go? We were at around 16,800 not too long ago. Do you see us go lower than that? I mean, how could it be a 10% correction from here? And that factored about the second half of the year being good. How good can it be? Where do you see the Nifty headed? All-time highs?
Yeah. So it's very difficult to say the number-wise, but we feel that definitely we have to look at the global backdrop. We cannot isolate India for what is happening globally. So we feel definitely in the next few months or so, we might see more pain looking at the way Fed is going to keep interest rate higher. Our house view is that Fed is not going to cut in the second half, but will keep interest rate higher for longer. And that might see some kind of consolidation in the global market or correction in the global market. And obviously, India will also see some rub-off impact of that correction. However, from a medium-term perspective, we think that market is clearly underestimating or underappreciating India's resilience and the growth. Right. So, as I mentioned earlier as well, 7% growth in FY23, despite the war broke out. We have seen steepest rate hikes. We have seen real estate defaults in China, but still India clocking 7% growth. It is commendable. And the next year also, we are going to grow somewhere around 6.5%. Inflation is going to fall below 6%. So we think that there would be a good recovery possibility once the interest rates globally starts to peak. And in fact, our view is that if global growth slows down, we don't expect developed markets to go into a significant recession or a marked slowdown. We think that there could be a minor slowdown in the global markets as the authorities are reacting to this, defaults by the bank, or even probably we might see more trouble. But the authorities are very agile and they are taking steps to contain the contagion impact. So we think that second half, once the interest rate starts to peak out and market starts to build in kind of a rate cuts, we might see more upside to India. And I won't be surprised if we start trading again back to 19 times when we see interest rate starts to fall in the next 6 to 9 months or so. So we remain a little bit constructive in the medium term. In the near term, yes, we are a little concerned about what is happening in the global financial markets.
Right. Take your point on where the frontline index would be, and the fact that you are more bullish on India than the world right now, which is also visible in the kind of exposure that you have with regards to the positive list. You have FMCG, you have automotive, you have multiplexes, you have basically all the sectors which are India facing as against global facing. But my question is very specific towards the pharmaceutical space, because I remember a few months ago you had said that you are increasingly overweight on pharma, like the fact that the corrections have made valuations attractive. Thereafter, for a few months since, we saw continued underperformance, But now it's coming back in favor from a lot of these large contra investors. They are finding favor in pharma. What are your thoughts here?
See, Mangalam, it's always that when the global growth slows down, definitely market would like to hide in defensives, and pharma, FMCG, and IT are the sectors that we like. We think that IT will have more trouble. So we already overweight on FMCG, and we think that some of the pharma names which are less exposed to the global theme, but domestic pharma names could be looked at. Whether it's in the healthcare space, we like all hospital related stocks. We like some of the chemicals companies which actually produce chemicals for the pharma sector. So the API manufacturers, some of the companies that are into chemical industries, those are the sectors that we prefer in the pharma sector, because we think that if the global growth slows down, there will be lot, good buying interest coming in these kind of names.
All right, Jitendra, I also wanted to ask you, you've given a few of these picks that you like, sectors that you like: autos, banks, real estate. Let's speak about the real estate space. This RBI cut that you all were anticipating, but the street was, going in with around 25 basis points. You all were going in with the pause. Do you think real estate stocks would look up from here? And how do you play this theme? Do you play the real estate stocks? Do you play the financing stocks? Because, they as well get an additional fillip now, since the cost of borrowing will not go up. Or you'll play the ancillaries, tiles, ceramics, pipes, all of that.
Yeah, Nigel. See, we have been very positive about the urbanization theme. We have written on urbanization, for the past few years, and we have been pretty positive that the per capita income of India is going to rise from here onward as the urbanization rate accelerates, and we continue to maintain that view. Now, why real estate? We were of the opinion that RBI is going to pause. Our expectation was, even if Fed raises rates by 25 basis point, it is prudent for RBI to pause because inflation trajectory is going to fall after, let's say, March, because last year the war broke out in the month of March. So on a YOY basis, we have a higher base, and it remains to be seen the kind of impact that 250 basis point hike by RBI yet to get completely felt into the system. So we do believe that on the demand side, there is enough demand. Inventory levels are lower. We are coming out of a very, very downward trajectory in the real estate sector for past several years, and now the per capita income is going to go higher. That was our view. So structurally, we became very positive on the real estate stocks per se. However, real estate industry, if you look at the developers, it's little bit higher beta kind of names. We have also seen job cuts, job losses, and hence we can't go outright bullish on the developers side, right? Because the pricing growth is little tough to come by when you have several job growths. So definitely real estate, we will play stocks which have very, very strong balance sheets, stocks that do not have higher leverage, and also they have some of the commercial assets, right? So whether it's malls or whether it's commercial buildings. So we feel that a mix of these assets would be preferred over a pure play developer which is niche and very focused in particular market. Number one. Number two, we think that some of the tile companies are better positioned because the gas prices have started coming off. However, we are not very bullish on the paint companies given valuations, and the supply side is going to see tremendous growth over the next few years, which will be easily absorb the kind of rising demand. So we are negative on the paint companies, at least for the next few quarters or so. So tile, yes, we like real estate developers. Coming to the financing space, I think it's pretty crowded, and hence we think that you have to be a little cautious here. The margins in the housing segment is not that great. So we remain a little bit, on the sidelines in terms of housing finance companies to play with. But definitely real estate developers which have strong balance sheets, very diversified portfolios, and tile kind of companies that we like. We also like some pipe companies that we have in our portfolio as well.
All right, Jitendra, we'll leave it there. Thanks very much for your time. Good speaking with you, as always, here on CNBC.